Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Welcome back. I'm sorry, another late start, but I have to take the kid to band. I always told them, like, band is not the extracurricular activity you want to do, but nobody would listen. Nobody would listen. So here we are on a Tuesday. Let's see how we fared overnight. It's New Year's Day in Korea. Oh, really? I didn't know that. No, the different calendars and everything. That's so weird. Okay. Let's come over here to ZN first. So we did have a huge jump overnight yesterday off of the whole, it's showing my robots. I don't really want it to show that on this chart. Let's turn that off. Do not plot. Okay. Anyways, huge jump. It did come back quite a bit throughout the day as the S&P 500 appeared to recover. We are a little bit lower today, but not by much. It does appear that the risk off across the markets has held somewhat. Here we have the S&P 500. They spent most of the day recovering, but the gap and everything else was just way too much for them to be able to clear it all in one day. We're going to see if today and tomorrow, if they're able to recover that. But I think one of the issues that we might have in doing that is that we have a Federal Reserve meeting tomorrow. So I'm not so sure if there's going to be a ton of people really willing to take on big risks at this moment. Over on oil continues to move, and there was a pretty big plunge yesterday. So gold and silver, kind of a similar story there. Copper. I don't know, so many of these charts look similar, huh? Look at that. There's oil, gold, silver. Maybe not gold and silver as much, but oil and copper look pretty similar. Here's the Japanese yen. So the Japanese yen actually came almost all the way back. So that's also really interesting. And the dollar's at 107.67. So I think like the one kind of, what is it? What would we say? Bright spot in all of this is that the dollar has not just shot up to all new all-time highs, because that would wreak a lot of havoc all over the place, right? Bitcoin also really taking it on the nose with the rest of the tech. They tried particularly hard to boost the price and pull it out, but geez, it's actually getting a little bit volatile there in Bitcoin, I kind of feel. All right, so coming back over to here. So what do we got to do? Okay, so we're just below 109 even in the treasuries. There is a little bit of an upside that has come through so far, though. Octavia says pretty thin book. Well, I mean, the liquidity in ZN looks about average to me. And the liquidity in ES is pretty light, but I would say normal for the pre-market session. Got a few things to do here. Oh, there's a 4K at 25. 4,500 actually. It's actually kind of a weird place for there to be a large order. So Minimize is saying, I watched your new video about you not using price to trade. And now, well, I didn't say price action. Price action, you know, like price action is a loaded term, right? Price action is like, you know, certain setups and things like that. But I'm saying that you don't need the price itself. That the price does not have as much informational value as everybody assigns to it, especially not on short time frames. But anyways, the rest of your comment, I would say that it could only work in markets that have long-term trends and very strong fundamentals behind them. Well, okay, so that's maybe kind of the thing though, is that what you're saying is, okay, so news will really move the markets, long-term trends will really move the markets, but those aren't always at play all the time. And so if those aren't around, then I kind of need to rely on other things to make money. And one of the ways that I can do that is quote unquote price action, right? Well, I haven't seen any evidence that supports any of the strategies behind price action. And I haven't more broadly seen any evidence proving any kind of reliable signal that you can use based on price whatsoever that works on like a 1 minute bar. So I would say that in those situations that you really just don't actually have an edge, and that maybe you shouldn't be trading those markets or trading at those times, right? But you know, I was kind of, so I had a comment on Reddit the other day that attracted a lot of attention. It was kind of weird because I had one person that argued with me, and I was like, you do not understand what I'm saying at all. And they would just not listen. They're like, agree to disagree. And I'm like, no, it's not that you disagree with me. It's that you just literally don't understand what is being said, dude. But I digress. And in that post, somebody was talking about how come like it seems like every time that I get in, that's when like it stops and turns around on me, right? So the Tom Hogarth is not empirical evidence. That's anecdotal evidence. And I don't know if we completely understand exactly how he trades. You know, is he using like multiple contracts, all of these things? Sedge might be coming from where he doesn't realize it. And not only that, but then we would also have to have like verified track record and all that sort of stuff too. I kind of midnight. I kind of feel like you're not actually watching the channel, man. I kind of feel like because almost anybody that's been around for any period of time should know that argument would be a dud. Okay, but anyways, so here's the thing: is you have some signal, right? You're like, when I have an inside bar and there's volume with it, and maybe we're like somewhere in relation to the last swing or something like that, and then that's my signal and I get in, right? Okay, well, if you got this signal from somebody else and it's a popular signal, then that means that there's probably going to be tons of other people trading it, right? But let's just say that you came up with it on your own and it's a completely unique spot, right? Well, there's going to be like multiple components to it still, right? So essentially what you've done is you've taken like 3 or 4 different things that don't happen all the time, right? Each one of those components, like it's an inside bar. An inside bar doesn't happen every bar, right? At the very least, it would have to be less than 50% of bars, right? But I think that most things that people are using probably happen on less than 10% of bars, maybe, right? And you're kind of going to adjust it based on, you know, you want it to be something that maybe happens multiple times per day so that you can trade it, right? So it's going to be something that happens 3 bars out of 144. Right, so something that happens like 0.3% of the time. Okay, but each one of those conditions might happen more than that. Like each one of those conditions might happen 1% of the time. Yada yada. Right. So there's going to be a certain number of. So basically, you have like, here's all of the bars that contain this thing. Here's all of the bars that contain this thing, and here's all of the bars that contain this thing. Right. Now, there might be somebody else that uses this condition and this condition and this condition, right? So they trade this. You trade this, but it could also be, let me go back. It could also be that they trade this condition, right? This condition and this condition. Or maybe one of these is shared with you. Maybe one of these is shared with you. That's the intersection of the conditions, right? So by looking for a bar that is unusual in some way, that doesn't happen all the time, you're actually kind of selecting something that a certain number of other people are also looking for as well. They might be looking for it for other reasons, but basically there's something unusual about that bar. There's going to be more people interested in trading on it, essentially. So you kind of get this situation where multiple people will all try getting in at the same time. So by trading a signal, you are essentially, the very act of trading a signal kind of causes you to trade at the same time as other people and increases the chances of creating a liquidity hole, right? Well, we don't really have a good example right now. I think the last time that it was added liquidity hole was 28, but if you get a ton of volume here, a lot of people trade it, and it doesn't even have to be all at once, right? It can just be like it stayed there for a long time. Market maker doesn't want to put up liquidity at those two prices, so you have like no liquidity at 28.5, or at least minimal liquidity, and then there's more liquidity above that. So if you try to go above that, the offers will hold you back. If you try to go below that, the bids will hold you back, and so it just kind of rests there in the middle zone. Right? What's an inside bar? An inside bar is like, you have a bar that's, oh gosh, I can change the color there. You have a bar that's big like this, and then the next bar is completely inside of that. That's an inside bar. So the open, high, low, close is within the range of the previous bar. So here's what I do. And here's the thing, is you're talking about like timing your entries. I've been doing a bit of work on my own, trying to find like, can I find a signal that reduces the amount of adverse excursion against me? And you know what? I haven't found it. I haven't found any kind of signal that like you just say, I'm going to enter in on this signal, and then I'm going to hold it for 5 minutes, or I'm going to hold it for 30 minutes. And then I'm going to, do all of the math. Maybe there's some Monte Carlo simulations involved in there. And I compare that to like a completely random trade. And is my MAE less than the random? And every time the result that I get out is that it's entirely a function of the volatility at the time. So if there's more volatility at the time, then there's more MAE, and if there's less, then there's less MAE. And that's it. I haven't found any kind of signal where it's like, the volatility is relatively good, but there's not very much adverse excursion against you. I can't find it. I can't find it. I've tried so many different things, man. Like, there's so many different things. And I'm like literally trying like thousands upon using machine learning to try thousands upon thousands of different things, right? Okay, just because you haven't found it doesn't mean it's not there, but that doesn't prove that somebody's found it either. Right? And what would we have to actually do to prove it? Right? We would have to be able to show it using the market data. We would have to say, when you see this phenomenon and you get in and you hold it for 30 minutes, that the MAE is less than is justified by the volatility at the time. essentially. That's essentially what you would have to do, right? But what I was kind of trying to say, Midnight, I think you're kind of missing the point there, was that the very fact that you're looking for a signal kind of works against you. So we actually have a very good reason to believe, based on what we do know about the markets and what we have proven about the markets, we have a very good reason to believe that short-term price-based signals are just not going to be effective no matter what. Because like everybody clusters, and then that makes price more sensitive to orders in that location, and so they all just chop each other up, essentially, right? So what do I do? Because I'm explicitly trying to avoid that. I'm looking at it, and I'm going to come over and I'm going to bring up my chart, and I'm going to say, well, first of all, I come in and I'm making my decisions based on things that have absolutely nothing to do with the current price. Okay? I'm looking at sentiment. So there is some risk off sentiment because of yesterday. But there's also going to be some mean reversion, try and trade it back sort of stuff. So those are two flows. And then there's also, what kind of things do we have going on today? Do we have any economic news? Not really. Case Schiller. Not really a huge thing. We do have a 7-year auction, so that is something that tends to be like maybe to the downside at the beginning of the session, but as the auction comes along, it's usually a boost. And especially given this situation, it might be a boost. Okay, so let's just say for the sake of argument, I think based on that analysis that it is a buy, but it's only a very, very tepid buy, so probably not enough for a trade. But we're just going to be saying, based on what we know, and all of those things that I talked about really don't have anything to do with the price chart that you're looking at right now, right? None of the information that I just listed out there to make that call that it's going to be long had anything to do with what's on that chart at this moment, okay? So I've decided that I'm going to go long. How do I decide where I'm going to get long? Well, one thing is that I can come back over here and I can kind of say, well, there's an iceberg at 28. I want to buy, and there's an iceberg at 28.5, so that's a good place to join it. Okay, sure. There's a place where I can catch the edge at 29. Well, that one moved a little bit too fast. Maybe I think I probably could have gotten in there at 29 actually when it came back. Okay, that would be a good place to go long. Or maybe I want to wait. Maybe, I think that they're not quite, whatever kind of meta orders are going on in the market, I don't think that they're going to come through yet. So I have some time. So I can kind of let it wander. Maybe I might trade it based on where it is within this range. Like I'm going to expect it to kind of trade between 29.5 and 28. So maybe I can get 28. But another thing that I will do is I'll come back to this chart and I'll say, is there anything unusual about this? And if there is, then I don't want to trade it, right? Like I want to trade in the most boring, typical, nobody thinks there's anything special about this area. There's not a lot of volume being traded. There's not a lot of movement. It's just not interesting. I would also say that I always err on the side of being too early. And that's how I get in, right? Okay. Are you aware of the Medallion hedge fund? You know what they're using? No, I don't think that that's what they were using. If we're thinking of the one that I think we're talking about. Oh, maybe Medallion hedge fund I think we're talking about. Okay, you're talking about Renaissance Technologies Fund, right? Yes, okay. We don't know what they used, Midnight. Like I'm still like, are you actually watching? Because we've talked about that in the last week. Like we talked about that last week, and I even talked about what I think that they're doing and why I think that. Yeah, so wait, you think the most successful hedge funds of all time was comprised of people like us trading basic technical analysis patterns on timeframes too fast for the human mind to react to? Yeah, so let me tell you what we do know about them. For starters, we know that they started with momentum. Okay? Which is to say that you look at daily bars and you have certain signals about when you're going to get in and out, and basically commodity markets show have a tendency to trend over very long time frames. Okay, and now how do I know that? Because Jim Simons literally said that. If you listen to him, I think it was the number file interview. I think they did it on number file. Yeah. Hold on, I'm gonna find it. I think it's over this one. Yes, it's right here. I found it. Yeah, there we go. All right. Pause. Oops. Wrong tab. This tab right here. Put them on full blast.
There's something called the efficient market theory, which says that there's nothing in the data,
wait for it,
which will indicate anything about the future, because the price is sort of always right. The price is always right in some sense. But that's just not true. So there are anomalies in the data, even in the price history data. For one thing,
okay, so what did he? Well, he just gave you a really key clue there. Did you guys catch that? Okay, so he said, what did he say? He said, okay, yeah, there are anomalies in the data, even in the price data. You know why he said that? Because the strongest anomalies, the anomalies that are the most proven and the most consistent and the most kind of like out of whack are all only evident in the order flow and not actually in price. Because market makers inject so much randomness into price that it's really, really hard to find those in price. But when you go to other data series, like things like the stuff that kind of is going into people trading, like sentiment, news, order flow, then you don't have that noise. There's more inefficiencies that you can find. So the reason why he said even, I think, is he's saying there aren't very many anomalies in price, but even in price, there are some anomalies. Okay? But you caught that, right? Do you want me to play that over again? Let's just go back here.
There's nothing in the data, let's say price data, which will indicate.
Again, let's say price data. He's saying that because there are other data series that you can look at other than price, okay?
Anything about the future, because the price is sort of always right. The price is always right in some sense. But that's just not true. So there are anomalies in the data, even in the price history data.
Even in the price history data. Okay, who is that? This is Jim Simons, the founder of Renaissance Technology, which is basically the most profitable hedge fund in history. There's somebody that this is a fund that returned like a 30% year over year return over a 30-year time period, which is just absolutely insane. Most of it was during a certain time period. It doesn't perform it as well now, but they still do pretty darn good. Okay, anyways, now he's going to say the thing that I want you to that we're here to watch, okay? To pay attention to. Listen to what he says here.
One thing, commodities especially used to trend, not dramatically trend, but trend. So if you could
Okay. Commodities have a tendency to trend over long time frames. So that doesn't mean you watch a 1 minute chart and you're going to find a trend and you hop on it. But when you're looking at daily, weekly, monthly charts over a period of several years, you will find that certain commodities will go in certain trends. This is a statistical anomaly that Renaissance was one of the first ones to pick up on. But since that time, there has been a great deal of research proving that this inefficiency, if we're going to call it that, exists in the markets. You can go and look it up, search for time series momentum, TSM, time series momentum. That is the keyword that you want to search for. It will bring you to articles on SSRN and ARXIV or archive.org that prove this phenomenon in the data. Okay? So Renaissance technology started with momentum. And if you go and you read books, there's like this book like The Man Who Solved the Market, which kind of talks about like the evolution of Renaissance technology and kind of gives the hints about the things that we do know. It's pretty well established from the stuff that I've read. Another book that's also worth reading is called More Money Than God, by the way. Okay. Renaissance technology started by trading momentum. Okay. That's why he's bringing this up. He's just like, well, at first we were like, can you actually make money from the market? Because at that time, everybody believed in the efficient market hypothesis, right? And they found trends and they said, oh, okay, the market's not perfectly efficient. Let's keep looking.
get the trend right, you'd bet on the trend, and you'd make money more often than you wouldn't, whether it was going down or going up. That was an anomaly in the data, but gradually we found more and more and more and more anomalies. None of them is so overwhelming that you're going to clean up on a particular anomaly, because if they were, other people would have seen them. So they have to be subtle things. And you put together a collection of these subtle anomalies, and you begin to get something that will predict pretty well.
Okay. So they searched for statistical anomalies in the market and combined those different anomalies together into a strategy, and eventually you get something that's relatively effective. Okay. But you know, earlier, as I had already pointed out, he talks about price as like even price, kind of suggesting that there are other anomalies. So here's what you do. Here's like the natural evolution of this. The first thing is you start trading commodities, right? And you start doing well and you start getting big. And what you're going to notice as you do well and you get big is that as you trade, it moves the markets. One of the things that I was watching the other day was there's this podcast called I always forget the name of the podcast, but I really, really need to remember it. It's Strong Source. You can go find Strong Source on Spotify. Strong Source on Spotify. And the guy that does that podcast, somebody that I've been following for a while on LinkedIn, is a commodity trader that traded at Cargill. So, and his specialty is the cocoa markets. And in one of the podcasts, he talks about how at Cargill, they could see when the momentum traders were coming into their market. And it was so obvious to them that they were able to like quantify how much money was coming in And if you take a couple of things and add like a var on top of it and everything, you can kind of predict where they're going to stop out of their positions even, and kind of use that to your advantage. Okay. But you're trading those momentum traders, they're going to move the market essentially. So one of the next things that you do is you try to say, oh, how do I reduce that effect? Is there a way to reduce my impact on the market? Okay. Turns out that there is. But it also turns out that one of those statistical anomalies that is very, very strong and well proven is the square root law, which is to say that the amount that you move it follows the square root law, which actually kind of advantages bigger trades. At first your impact seems linear, but as it goes along, you find it's actually follows the square root law. So there's kind of an upper bound. And then there's a point at which it goes, it's like volatility extends. So it's like, this is the max amount that you're going to trade. Okay. You figure out how you're going to move the market, right? So now I'm going to speculate. Okay. What you're going to do from there is you're going to say, well, if I know that I moved the market this much, and I know that there's this other fund over here that's doing this thing, and they moved the market this much, right? I should be able to say, okay, this market is going to move yay far. And when it does move yay far, how is that going to affect other assets? Because you're trading a momentum portfolio. A lot of it is like, what do you hold? So some of the work from Jean-Philippe Bouchot, who's my favorite researcher, a lot of his research has been like, you have a universe of assets, and what are the correlations between those, and what does that say about which assets you should hold and how much you should hold them in a momentum portfolio, right? So let's just assume that Renaissance Technologies was using some of those things. Now all of a sudden, you kind of have this dynamic system. You're not just looking at one asset. You're looking at like 1,000 assets, and you can kind of predict second and third order effects. You're going to say, this is going to move, and then this is going to move, and this is going to, and all of these correlations are going to go. It's a huge dynamic system that's, swirling around like this. It's a chaos. It's like a small deviation. Like if it moves yay far and then it moves yay far plus 1, and that's only a teeny tiny little amount, but that can actually result in a dramatically different result in a chaotic system. Have you ever seen those things where it's like you got like a little arm on the table like this, and then there's a hinge here at the center, and there's a piece of wood that's like this, and then there's another piece of wood that's swinging around like that, and these two pieces are like swinging around wildly, and it's like every time that you pull it up to the top and release it, the pattern that it makes is completely different, right? That's a chaotic system. There's sometimes there's multiple inputs. I guess in this case there's not really, but a small teeny tiny difference can actually result in a wildly different behavior. A chaotic system. So you're modeling this chaotic system, right? The next thing that you're going to do, because you're watching your impact, right, is you're going to try and watch the order flow to see other people's impact. Because you can't follow it just from the price, because, there's multiple people and things like that. So what you do is you buy the data from somebody else. And so here's the other piece of information that I know. I know for a fact that these firms, these hedge funds, buy order flow. And not just like buy order flow like the order flow that we're looking at. I mean, they buy order flow like they say, hey, Goldman Sachs, show us all of the, give us all of the data with all of the information about who's trading. You can literally buy that stuff and then analyze that and say, oh, well, there's this hedge fund and all they do is they just rebalance their portfolio on the last day of the month. But they're pretty big. That's a reasonable order flow for us to track. So I can go and put that in, and then I can go and put this in and figure out all of these different different points to see, basically track different order flows. So now you kind of get into this thing where it's like, okay, well, these guys buy at the last day of the month. So on average, we do tend to move up. But on this one day, we didn't move up. And why was that? Well, because here was these other 2 or 3 flows that we track that happen based on other conditions, momentum, whatever it is. And they happened to be selling that day and they overcame that flow. And that's why we turned down that day, right? And once you have it as a series of flows, and I'm using my hand and I'm like 5, but we're probably talking like thousands of data series, right? Now all of a sudden, you're tracking all of these oddities in the flow. You get something that is extremely effective at predicting the overall flows in the market and making trades based off of them, right? And then on top of that, you're adding that you're going to be using market making techniques where you're placing bids and offers on the DOM based on correlated assets, things like that. You're really fast. All of those things kind of compound on top of each other, right? So I would say that Medallion, I wouldn't necessarily explicitly say it's high frequency trading. I don't think that their key edge is high frequency trading, but I do think that they were using high time frame frequency things. So this is another thing, is that in the order flow, some of the things that we know that are very predictive are really short time frame. Like I can tell you when the offer gets below a certain amount, it's extremely likely that we will tick up, like we just did right there. Okay. It's called catching the edge. It happens on such a short time frame that a retail trader or human probably not going to be able to take advantage of it very consistently, but if you're the fastest person out there, you can. And there are people that do that. Okay. That's kind of an order flow based edge though, right? He's not buying it based on anything to do with the price history. He's buying it based on the number of contracts offered, essentially, in that situation, right? Okay. So the basic gist of what I'm saying is that I believe, and I have reason to believe, although I can't prove it, because Medallion is extremely tight-lipped about what they use, right? But we have reason to believe that they started with momentum, and momentum kind of led them into watching individual order flows and front-running those order flows. Okay. The hedge funds out there that are profitable, I'm telling you, they buy the order flow. I know for a fact that they buy the order flow. Okay. And what we know about markets, it makes sense. There's too much noise in price. So you actually, price is just the result. Price is the result of, millions of different people trading. And if you can kind of categorize those people into different strategies and to different institutions and find things that predicts what those individual people are going to do, then all of a sudden you get this gigantic dynamical system that actually predicts what price is going to do fairly well in a way that you can't from just analyzing the price. Why? Because the price is just a result from all of these other pieces of data interacting with each other. Right? Man, you really don't listen. I seriously, Midnight. Like, I really think that you should have a little bit of reflection and note that you are probably not picking up all of the information because your preconceived notions. So let's go back a second, because you said that just proves that there is edge to be discovered. I never said that there's not edge to be discovered. What I said was that I don't think that there's anything that you can do with just a 1 minute price series that will reduce your MAE, other than taking note of what the volatility at the time was. That's what I said, something like very, very specific, right? I mean, if there was no edge to be discovered, then I would just never trade, right? But we do trade because there are some edges that I know of. And I don't always, there are things that like I talk about. I don't necessarily always tell you guys every little bit of what it is when I'm taking a trade, because I don't want people to try and follow me. But I am giving you all of the information to figure these things out on your own. Right? Like that a lot of those edges can be found from looking at the order flow and not the price. That a lot of those edges can be found by tracking news and macroeconomics and things like that. Tracking higher time frames. But the 1 minute chart, mostly noise. So see, you have a hypothesis, which is that I can make money purely by analyzing a single 1 minute price series. And the null hypothesis in that situation was that there's no edge in that, right? And I am adopting the null hypothesis, which is a pretty good bet. It's a pretty good bet because more often than not, the market is very statistically efficient. It's not very informationally efficient, but it's very statistically efficient. So if you're trying to say that I'm going to find a statistical aberration on a 1 minute chart, the bet is that it's not actually a real edge. Okay. So then what we have to do is we have to prove the null hypothesis wrong. How do we do that? Well, the null hypothesis would be that it's random. So first we have to show, what does a random market look like? Right? Then we identify our edge. We say there's a certain situation that is not random. And then we show the behavior of the market in that location. And we can show that there is some statistical difference between the market in that specific condition and our random model. That's how you would prove it, right? Do you get what I'm saying? Do you understand how the scientific process works in relation to doing science on markets, right? We need to prove something using the data from the market. Now, why do I say you do that? Well, because we know that the market is very reactive to all orders. So I can't just go and read something on the internet. If it works, then it's going to get popular. It's out there and it works. People are going to make money from it. They're going to tell their friends, everybody. The edge is going to be gone. So you mentioned Tom Hogarth. Well, there's all these issues with that, right? First of all, I don't have his trading results sitting in front of me. So I can't even actually verify his track record, Well, one of the things that happens a lot, I notice, is that people will have a period where they do well, and then they just write off of that one period. When you really look at the totality of their trading, it's not profitable. Yeah, blow my nose again. Another thing that I find happen a lot is that people will have some degree of success, but they either misunderstand or lie about where their success is coming from. And I really don't like talking about specific people, because like trashing other influencers is one of the kind of manipulative tactics that gurus will use, fake gurus will use to gain your trust, right? So when you find a guru that spends an inordinate amount of time talking about and trashing other people, man, that's like a big red flag to me. Okay, so I don't like talking about people specifically, but like in this instance, I give you an example that like the warrior trading guy, Ross, he has posted like records of him making money from stock trading for quite some time. But when you look at what he's actually doing, he's trading like a low float stock, which is to say a stock that is very volatile and doesn't have a lot of shares. So it's more reactive to like retail traders trading it. And so what he'll do is he'll come in and he'll build a position in it, and then he'll go and he'll tell his trading group about it. They'll all come in and buy it and increase the volatility, and then he will exit off of their volume. So he's basically front running his audience as far as I can tell. So he says, oh, it's because of all of these things, and I can teach you if you take my course. But then the people that take his course don't make money. And he continues to make money. And why is it? I think it's because he's front running his audience. So what does Tom Hogarth do? Well, we don't have the results in front of us, but that's why we should just rely on the empirical evidence, right? If Tom Hogarth says there's this certain aberration in the market, certain situation where when we trade, we can trade and have a better chance than not of winning in that situation, right? We should be able to prove it. We should be able to prove it empirically, I don't know. So this is the other thing is with Tom Hogarth is he was working for a professional. So there's all of these advantages that you have as a professional, like at working for a broker, that aren't applicable to you as a retail trader, right? But that's where it comes back to, okay, like his style. So like, what is his style? What are the specific edges that we're talking about here? And like, let's not talk about Tom. Let's talk about the market. Let's talk about what are the behaviors in the market. Can we prove them? If we can't prove them, then I just don't think it's worth talking about. Really don't. Right? Because at that point, if you can't prove it, then you are either if you believe that the market does a certain thing and you cannot show evidence of that thing, to other people, empirical evidence, then there's only one of two explanations for what you're doing. Either one, you are just blindly trading something. You're like a flat earther, essentially. You believe something without any real evidence to be able to prove it. What was the other options? I can't remember what the other option is. I guess the other option would be, okay, so like what I mean by that is the world is a certain way and you're just in abject denial of that world, right? Or is just random and you just believe something off of faith, right? And this goes back to all of the crazy science-based beliefs that people believed in the past that have been disproven, right? Like people used to believe in spontaneous generation. Spontaneous generation used to be a thing. They'd say that flies will spontaneously generate from flesh. We don't understand how it happens, but we don't see any flies having babies or anything. So, well, it turns out that the eggs were just too small for us to see. Okay, but people used to believe in spontaneous generation, and we proved it wrong, right? If someone has an edge, why would anyone show it? That makes no sense. It's true. It's true. I mean, sometimes an edge... So again, edge can be created by the structure of the market, right? So there are some edges that, like, even though there are people trading, they would still kind of persist because they are structural, essentially. Momentum is one of those. Commodities don't trend quite in the way that they do. You notice that Jim Simons was saying used to, because the behavior kind of changed when they started trading it. Now it's kind of cyclical. Why would Tom show you? Don't ask me. I don't watch Tom. Everybody's saying that Tom is a guy and you can follow him and that they've based their trading off of his. So he must be showing them something, right? You know. I mean, this is another thing that I think kind of gets wild, is that you get all of these people following some kind of like way of trading, and then you're like, okay, so let's do some empirical research based off of it, and they can't actually tell you the things. You know, most people can't even tell you how inventory works. But that kind of reminds me, on our inventory cost basis, kind of just been pushing across those two lines. So it really does look to me like that there's just not a lot of interest in the markets today. I need to make I think I'm going to make a video about that. I was also thinking, because on the last video Octavius has resorted to, let's post on every video about when we're going to convert the indicators over to Sierra charts. But I was thinking about it and I was like, well, I don't know if I have enough time to convert all of the indicators over to Sierra charts, but I probably have enough time to convert that one. I would rate this as your best stream I've ever... you know, really? Because I kind of feel like it's a little bit... like for you, D, this should mostly be like... you know, I take that back, because I've never gone and shown you guys that Jim Simmons video, huh? That was pretty good, wasn't it? You can kind of see where I'm picking up on it, though, right? It's like, when you know the research... This is the thing that's so wild to me, is when you read the empirical research that is out there, and then you go and you watch these people that we know have made big money from the markets. Like they're a hedge fund and it's well known and established. Like we all understand that Jim Simons made a ton of money from the market, right? If you understand the research and then you go and you watch the interviews with them, you can kind of see them like unintentionally dropping hints. Why would he say even in the price data? Because it's really hard to find the aberrations in the price data. There's more aberrations in the order flow. That's just facts. And he's like not explicitly telling you that, but he understands that, and he kind of like inadvertently tells you that. Most people don't know the significance of last Friday's inventory sellout. Well, okay, so let's talk about this, because I've heard a lot of people trying to say that the sell-off yesterday had nothing to do with DeepSeek R1, etc., etc., etc. And I disagree. I disagree. And the reason I disagree on that, and I'm not saying that that's what you're saying, but I've seen that out there, and maybe that's what you're thinking about, is because, number one, we had a gap. So the market moved down significantly over the weekend without any volume trading. Okay, so there was a gap. So like if somebody's selling a lot of something, like they need to raise cash to put money into this $500 billion fund, whatever it's called, for AI, right? That's going to be something that you're going to see like when markets are open, and it's going to be like a persistent trend, and you're going to see the telltale signs of somebody executing a large meta order. Right? So something like that. Did I get that right? Yeah. I drew that right. Okay. Now, I think the reason why people are saying it can't be R1 is because R1 was released like last Monday. So like, shouldn't the market have sold off when DeepSeek came out? Well, I think that what actually triggered it was not DeepSeek being released, but DeepSeek hitting #1 on the Apple Store. Because kind of what happened, I saw the slow burn. Is like, I saw when it came out, I saw people talking about it and saying like this seems like significant thing, but it's China and kind of iffy. And then like as the week went along, people started trying it and sharing their results with other people and going like, actually, this is really crazy because this seems just as good. And so then other people started trying it, and then it quickly rose to the top of the Apple charts. And at that point, all of the traders and everything started to pick up on it, because I was kind of watching that open, expecting that we would probably have an open lower, and we did immediately lower. So I very much, I think that all of the evidence that we have points to the decline being largely from DeepSeek R1. And the kind of one, so there's a couple of other things about this. Another argument that I hear from people is, well, NVIDIA shouldn't be worth less because of DeepSeek R1. I'm not sure I agree with that, but like, here's the thing. I don't know if it really matters. So again, because that approach is basically saying, okay, we think that NVIDIA is going to sell X GPUs over the next 10 years. And now that DeepSeek R1 is out, we adjust that, and we think that that NVIDIA is going to sell less than X now, right? There are going to be less sales, ergo we should reduce NVIDIA in price, okay? But that's not really actually how the market works. The way that the market works is they say, well, that's bad, and so I'm going to sell the stock, right? The market is not informationally efficient. So this is the first one. Don't make the mistake in saying that the market is informationally efficient, right? But so if we just ignore the fundamentals behind it for a second, and we just focus on you know, the market and like what happened, something falling that far, like it's already happened, right? And what we find is that the impact of orders, that the market has a long memory. You trade something, that like you come in and you buy a bunch of something and you move it up like this, and then when you're done, there's like a short-term mean reversion period, but then it will just stay there. And in order for price to move away from there, somebody else has to come in and trade a bunch of it and push it. If nobody else comes in, it will just stay there. So that's what I mean by like the market has a long memory. The impact is permanent. So you have to understand that this thing happened already in the markets, and that has a permanent impact on that dynamic system. So exactly how that works out, you know, I don't have a sophisticated enough model to predict that. That's something that I think researchers are kind of getting to, and maybe in 10 years we might have models that do try and see these sorts of things. But today it's not something that I can know. All I can say is that I wouldn't just ignore it. This idea that it's like, it's nothing, just buy the dip. I think it's more complicated than that. It's further compounded by the fact that we have a Federal Reserve meeting this week. If the Federal Reserve meeting, we get to the press conference and Jerome Powell is like, well, we're really concerned about inflation and we're not likely to reduce interest rates at all for the next 2 years, something like that. That would be way extreme. But if he was to say, you know, like, I don't expect any more interest rate cuts for a year, which is kind of what he was saying last meeting, although not explicitly on the time frame. Okay, but if it was as hawkish as the last Federal Reserve meeting, I think that the market would sell off further. Now you've got some real problems. Now you've got some momentum. Now you've got real money coming out of the market. So it kind of already happened. It can lead to other things. I would be careful about just reflexively not buying the dip in this situation, okay? Now, was there, you know, and another thing is, I don't really remember there being a sell-off on Friday. I mean, come on. This all last week looked good. So no, I'm really confident that, well, okay, maybe there was this little bit right here. You talking about that? I don't know. That could just be like people rebalancing for the week, though. You know, I think this is a significant change in the market. You got to take note of. You really got to take note of that. Yeah. Well, you know, and to the argument, you could say that people were starting to sell it on Friday, because that's when I started to hear about it, was like late in the afternoon on Friday. The spoos. You're just now noticing that, or remembering that we put that on there. I love it, right? It's great. Oh, you know, by the way, I forgot. Did we, with our thing over here? Yeah, we do. We have them all over here. I should put spoos over here on ES, but I think that there's enough room. Anyways. Okay, sorry. So I've been yapping too long. Wonders of the Universe asks the questions. Good morning, Seth. Why do you trade in short time frames? So to be honest with you, I think that in most situations, it doesn't make sense to trade in short time frames. So why does Seth trade in short time frames? Couple of reasons. And the reasons aren't very good, to be honest with you. Okay. One of the reasons is that Seth is ADHD and he just likes the action. In all seriousness, I think that that's a major part behind why I enjoy trading on the short time frames. But let's just leave it at Seth enjoys trading on short time frames. I think that your edge on short time frames, for the most part, tends to be less. Okay. Seth also bases his trading very much on trying to take advantage of informational inefficiencies. So if I have some breaking news, I think I have some sort of insight into an issue that will give me an edge over the rest of the market. I think that I can predict what other people are going to do that day. Then you have an edge in that time period. Okay. So there are some situations, especially like news-based trading, where you can kind of pull an edge out of that. And because that's kind of where my strongest edge is, it makes sense to trade on that time frame. Okay. Like if I really, this is one of the things that doesn't make sense to me, is if you want to be a technical trader, swing trade. Seriously. You're much more likely to do, like, the thing is that there are high frequency trading edges that we know of, and there are swing trading edges that we know of, and there's like this huge gap between those two that there's not any proven strategy that I know of. So now the third thing is that there is value in just sitting here and watching it on the front lines. There are some of these insights that I'm able to gather about why the market might be doing something that I can gain from just watching the flows. I can see when those flows started coming in, and I can see what the news was and what the social media chatter was and all of those things at that time. So, and I can see how all of the different flows in the market are interacting together to kind of say, well, yeah, there's this thing, but there's also this thing, this thing, this thing. And that allows me to kind of filter out a lot of noise that people at higher time frames can't do because they just don't have that view into the market. So I find that trading on a very short time frame actually helps my higher time frame plays. And I have done pretty well on some of the higher time frame trades. I don't take them very often, but I've done pretty good on a lot of them. And, you know, that's something that you don't even necessarily have to like place live trades. You could just be sim trading. But I do think you want to trade because when you trade, that kind of like focuses you on the market in a different way. Like it gets dopamine going. It makes you watch it more closely. So trading it helps. But, you know, maybe trade a sim if you really don't have the cash. Making a video talking about like how much money do you really want to have to start trading. Have some interesting results on that, so you see that in a week or two. I think on Monday, I think today I'm going to record something about the inventory cost basis, and then you know, put that out on a Monday. Okay. Yeah, and AO says no buyers in sight. Well, the market very much seems like it is just chilling, waiting for Federal Reserve tomorrow. Okay, so is DeepSeek a better AI model or another category of thing that produces the same results? Okay, yes. So that's a good question. So there's two kind of interesting things about the way that they built DeepSeek that I think are a pretty big deal. Okay. The thing that you've heard is that they created DeepSeek with significantly less funding and compute power than what OpenAI and these other people have been using. Okay. What's the other one that starts with an A? I can't remember their name. Okay. So what did they actually do? Well, one of the things that they did was they trained it on the output from another AI model. So here's what you do is you have your model and you have OpenAI's, right? And you go and you give the input to OpenAI and it returns this thing. And then you go and you tell it, your model, I'm going to pass this input into you. What I want to come out is this. And so even though you don't know how the OpenAI, what data that they were using, the methods that they used to train it, there's all this stuff with the way that you do the reinforcement and all of this sort of a thing, right? You don't have to know that because you can basically train this AI off of this AI and get all of the value that this one has, or most of it, out of this one. Okay. This is something that has been kind of known for a while. But this is the first time that I think it's been used to real effect. Okay. And this is a huge problem for people like OpenAI. It's a massive problem. What is the point in spending all this money on compute, spending all this effort finding new methods, new ways to make an even better model, if somebody else can come along and utilize your work and create exactly the same thing for a fraction of the cost? Basically, just by training them against your work. Well, yeah, I mean, I guess there can be like laws and stuff to prevent that sort of, but this is China, so how are you going to stop that, right? And China put it out, made it open source, so everybody can download. You can run it on your own machine, right? So the reality of this is why I think that DeepSeek really truly is a game changer. The release of DeepSeek R1 basically means that the business model for OpenAI is defunct. They basically, with one fell swoop, just completely destroyed the business model of OpenAI. You watch. I tell you, this is going to happen. OpenAI is either, one, going to go back to what they were supposed to be in the first place, which is kind of like an open research team where they're supposed to provide us the models and everything about it. And it's an open source kind of thing. OpenAI was not meant to be a for-profit company. Sam Altman turned it into a for-profit company when he saw how much money there was in it. Now that the money has been taken back out, I think there's a very, very good chance that they go back to what their original mission was. And if they don't do that explicitly, they're at the very least, they're going to announce collaborations with open source projects and universities and things like that. Guarantee you that's going to happen. Because DeepSeek basically says the amount of investment that OpenAI was putting in there doesn't make sense. It doesn't make sense. Now, does that explicitly reduce the number of NVIDIA GPUs that are going to be sold? I'm not entirely sure. I think that in the short term it does, because the issue is like all of the people that were going to buy all of the GPUs, they have to completely rethink everything, right? So maybe a different group of people comes in. Like if we can all run our own local models and having like your own massive, like I could go and I could spend like $20,000 on GPUs and that will allow me to run like a larger model and a more effective model, and that might help us, right? So it might be a thing in the future where like everybody has their own little compute thing in their house somewhere for their own local AI. And then you're running that local AI and you're training that local AI against you so that it's personalized. I could see a future like that, right? And in a future like that, if everybody's buying, compute clusters, maybe that's actually more NVIDIA GPUs, right? But in the short term, all we know is that the people that were buying them probably aren't going to be able to buy as many. So that flow is going to have to be replaced, and we'll see how the market sorts that out, right? The second thing, though, is that basically what has happened with OpenAI and some of these larger models is they'll run into a roadblock. And they'll say like, we're trying to teach it this thing. We have this problem. How do we deal with that? Well, let's just throw more compute at it. And that's what they would do is they would just use massive amounts of compute and solve the problems. And what happened with these Chinese people, Chinese researchers, is they didn't have all of the compute to throw at it. So they actually solved those problems. And if you go and read the papers that they put out, they have a pretty detailed description of how they were able to structure a reward mechanism in the robot or in the model to more efficiently train the model. This is really important research. Like if we're going to try and utilize machine learning to make a high frequency trading robot, I really kind of feel like that if we were going to take the high frequency world on, that we probably need to utilize machine learning to some extent. And a big part of the machine learning is like what your reward function is, because if you have the wrong kind of reward function, it will cheat. It will find a way to get the reward the easy way instead of actually doing what you want. And these guys found ways around that. They found ways around that are real big game changers. So that's the second thing, is that people like OpenAI should be able to utilize these enhancements in their own projects. So all of the AI projects that are out there are going to become hundreds of times more efficient. I've seen some people arguing about, well, maybe China actually has more compute, or maybe this company, DeepSeek, has more compute than they actually let on. I think that that's actually probably a likely case. But you look at the stuff that they posted, they have, like, they gave you everything. So other people are going to be duplicating this thing within weeks. It is an absolutely just stunning shift in the AI world that is kind of in a bigger shift in the AI space than the shift of AI and LLMs was overall. Like, the thing was is that when OpenAI came out on all of these things, I was like, okay, let's try and do it. I'm going to download a model. I'm going to use it. So one of the things I did was I made a model that could just listen to me speaking and transcribe me speaking. I got it to work. I can't really, if we do it on this computer, it uses so much power and everything that I can't really do anything else on it. So to use it, basically, we would have to have like a dual PC setup sort of a thing, which I have, and then I haven't really utilized that part. But it's part of it is because, you know, there's that much utility to me. It's kind of a little bit wonky, right? But now that we have these efficiency improvements, you basically now you can have local models, LLM models, that really are effective and really useful to you. So this kind of dream of, like, you know, having your own Jarvis that you speak to and everything is realistic now. Like I think that by the end of the week, you're going to have everybody utilizing their own kind of like local Jarvis. If it doesn't already, if somebody hasn't already made it. Somebody's going to take one of the models that do transcription and they're going to combine it with this other model so that you talk to it and then it returns back. Just like OpenAI's whatever is supposed to be, but for free and local. It's coming. Big deal. BS says, so we really only need one really good AI to train consumer AI. Yes. Okay, so now that you understand that, now you maybe understand why the whole idea of general artificial intelligence is kind of a big deal for them. Because they needed to have one model that will fit everybody's use case so that everybody will just come to them and utilize their service to use AI, right? When what we've always wanted to do is to do the models locally, right? I don't want to use ChatGPT. I want to develop my own ChatGPT that is built specifically for reading the markets, right? Well, now maybe we can. Maybe that's more practical today than it was 2 weeks ago. It'd be fun watching you debate Gary Norton on scalping versus swing trading daily charts. I don't know if it would really be much of a debate. I like the things that I'm telling you. I think that I understand the kind of the math behind things in a way that Gary is not familiar with. I think that was kind of the whole thing, is that, like, during his time, the robots and the algorithms kind of came in and basically took away what he liked doing, right? He can see where there's a place for humans to kind of add value in there. That's something that the robots can't do, right? And I think that he's correct on that. It's super hard to do, but you can do it. But I think he also kind of understands. I don't know how much he understands swing trading. That's probably was never his thing. But can you see this thing where it's like, well, a lot of people misinterpreted what momentum trading was and are misapplying it, because all the jack swag, like seriously, the vast majority of retail day trader culture comes from things that we were taught by swing traders, not day traders. I think that's, it's kind of funny how I stumbled upon that, because it really came from an argument that I was having with somebody. I was like, well, like, I don't think the technical analysis works. And then they said, well, but doesn't this momentum strategy work? And that's technical analysis? Okay, well, like, that's a different argument, because what is technical analysis is kind of an interesting thing. But that was when I realized that it was like, oh, well, momentum does work. We do know that momentum works, but it doesn't really have any applicability to what we're doing on an intraday chart. Now I see why so many people were led down this path that's a dead end, essentially. So you're trying to apply swing trade methods for swing trade momentum onto day trading charts, and it doesn't work. I feel like I'm getting a little bit sick, but I think it might just be allergies. Like, I chose not to take my allergy pill for a few days. And I may just be getting, an allergy fit. Okay, anyways, what was it? Yeah, so we really did I answer that one? We really only need one really good AI to train consumer AI. Yes. And I think that what should happen is you'll get those, you'll get models like DeepSeek that are open, right? And then you can kind of simplify them down so that they fit on your hardware, right? And then you should be able to do further training on your own to get the model to behave in the way that you want. Like, I would want to give the model all of these studies that we've done that we know of, like basically go through trades, quotes, and prices, find every reference in that book and feed that into the LLM, right? Take every live stream that we've ever done, feed that into the LLM, start asking it some questions and giving it feedback, and get something that's an AI that could basically replace me. I'm thinking this is going to hurt NVIDIA. Well, so again, like, how many GPUs are going to be sold now compared to what we thought? I don't really know. But that's where, based on what we know about markets in the short term, we don't have to go that far. We know that the release of this is a massive shift in the AI space. NVIDIA is the AI proxy. So people are going to sell it purely because of that. So, like, what we can do is we can just kind of enjoy the downside, kind of let them sort it out, and kind of, assess after the fact when people have done a better analysis of it to find out how many GPUs actually will be used and stuff. GPUs aren't even the main part of their income. It's the server farms. Yeah. Well, okay. So that's an interesting point, because you're saying, well, if you're saying that basically the demand for server farms will go down, but the demand for consumer cards will go up, possibly, maybe. I think that there is a possible case that there's still going to be a lot of server farms. Like, the way that it's working right now, there's OpenAI and Anthropic, and then there's like the four main consumers of this stuff, like Apple, Microsoft, Facebook, Amazon. Is Amazon one of those? I'm not sure. Right? And these were the guys that were like spending all of the money on these sorts of things. Well, now you don't need nearly as much power, right? But what that also means is your regular company, like the companies that I worked for, like, I guess I shouldn't use names, but, these aren't huge companies, but they're companies with stocks and things like that. Now they can kind of get in on that game. So maybe those smaller companies will replace that demand? I don't know. I notice with GPT and other AI chatbots, it doesn't go into the technical nuances, but sticks to the main idea unless you tell it which details to go. Yeah. I mean, the real issue with an LLM essentially is that it's not really doing logic. So I think if we took, so there's this one study about like we're gonna take we're gonna filter out level 2 changes and only take the significant level 2 changes, and then all of those changes we're going to build into a token that we can pass into an LLM, and then use the LLM to see if it can effectively predict what the next sequence of events is going to be. And what we find is that the market will tend to go into different modes. They identified 2 different major modes in the behavior of the book, and that it makes very effective short-term predictions. Okay, so if we take that model and then we say, okay, I want to do the same thing, but can it help me predict what's going to happen over the next 5 minutes? And I think that what's probably going to happen is that it's going to overfit with the skills and everything that I have. My bet is that I will overfit it, and that you get something that works really effective on the test cases that you kind of train it on, but then it's not able to make very good predictions. That's kind of my guess about the way that it'll go. Why? Because the chatbots aren't actually really doing logic. So I'm not sure that they're really going to be good enough at saying, like, here's this piece of news and this piece of news and this piece of news. This is the trade that we should take, and yada, 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 right? Might be harder than that. We might have to, I think that a chatbot is probably like a significant component of it, but I kind of think that to really get something that's useful to our use cases, you probably have to combine it with a couple of different systems. So do we still need humans? Well, okay, so this is a more interesting discussion. So do we get to this point where everybody has their own LLM to trade for them? We don't need people to trade anymore? Well, so a couple of issues with that. Number one, we know that there are swing strategies that kind of work, but if too many people are trading them, it kind of takes the edge off of it. It kind of turns into a cyclical thing. We also know that there are very, very short-term kinds of strategies. A lot of these require a lot of scale, but there are high-frequency trading strategies that work pretty okay. Then there's this whole area in between that we don't really know if there's profitable strategies in those or not. There's kind of some things that we know that kind of suggests that if you're making money on that time frame, it's because you know something that other people don't, and not necessarily because of anything technical, anything that the robots would do, right? So there's probably still going to be that area of noise that the robots would be participating in, right? But then there's this other issue, which is that the markets exist for a reason. Markets exist for 2 main reasons. People think that the markets exist because they're perfectly efficient. And that's the best way of possibly doing things. That's wrong. The 2 things that we're trying to accomplish is 1, give people a reason to participate in the system, and 2, to collect all of the information about supply and demand in one location. So we need some way of saying this area needs supply, this area doesn't. This is where the demand is. It's not here. And it encourages people to invest money into those places to fill those needs. So market's not perfectly informationally efficient. It's not nearly as efficient as I think that we kind of need to solve some of the problems in our society. But how else are you going to collect all of the information? How do you get something to say? BS over here, he needs to buy this thing, and MDHC needs this good, and you know, compute all of that into like what the effective price of things should be, right? So you still need humans that actually have needs. So you might have this situation where you say, okay, I need to buy this much of a commodity, but then I hand it off to the robot, and the robot executes that for me, right? But the robot itself doesn't necessarily have needs. Well, maybe the robot has needs. Maybe maybe we do get robots that are just running businesses on their own. You know, that could happen in the future. But they have need, like there still is a need for a market, essentially, because there's no other way to share that information. Even if you had this sort of a thing where it's like you put the orders in and it all goes into one central system, like how does this one central AI that you get come up with a fair price for everybody? It's just not. I don't see how that works, right? So I think the reality is that you will always need humans and you will always need a market, because the robots are just supposed to be serving the humans, right? And if they're not serving the humans, then they just become their own actor that also has needs and is possibly competing with the humans. But you know, like there's that whole thing. Robot, be a bro and get me that thing I need at 75. Yeah, exactly. Well, it won't be like that. It'll be like here's this thing that I need need to buy a bunch of this thing, and it's gonna say, okay, so I'm going to go and execute this with Holmgren Chris and all these things to spread out my impact and reduce it, and yeah. With in combination with all the things that I know about news and other flows that are happening at the time, and yeah. So you know, like another way of putting it is the market has already kind of been automated. Market making, at the very least, has been automated. A large portion of block trading is automated now. That's kind of part of why dark pools exist, was to make the process of block trading more automated. You don't have to call somebody. So like this kind of like theoretical dystopia where like the market is nothing but robots, I think that we kind of already live in it. I really do. I really think that for the most part, we already live in it. And that LLMs and you know, this becoming more accessible to people, that will be still a pretty significant change, but that it's already mostly automated. So I think that that's kind of like an important insight to make, because yeah, the markets became automated, but like, did that actually result in less jobs? Like, how did that actually affect our relationship with the markets? Well, there's more activity in markets than ever before. There's more people, there's more humans being involved in the markets than ever before, despite the robots coming in and taking over a significant portion of it. And it didn't result in less jobs. It actually kind of increased the demand for humans in many respects. Bots are fast but stupid, though. Well, maybe they're gonna get smarter, right? Like one of the things. I mean, this is kind of weird, wild stuff to think about, because we really are at the precipice of a significant change in our understanding of economics. There are certain ideas in economics, primarily this idea that all market participants are rational, and that markets should be reaching some sort of equilibrium. So most of the economic models that we use to try and predict what markets are going to do and everything just aren't really very effective, because like their entire premise is wrong. Once we understand that actors are you know, boundedly rational, they want to do their best, but but there's limits on what they can do. Now, all of a sudden, you can kind of look at the market as this sort of dynamic system of equations that, is chaotic in nature. There's been people been doing research on this for a long time, but now, I think in the next 10 years is going to be the time when this breaks out. You're going to see, I think what you're going to see happen is like baby boomers that kind of are attached to those ideas. They're going to leave, and all of the people coming into the markets, all the people coming into economics are going to learn these new, radically different ways of viewing things. And we're going to get the technology up to, because I think that our ability, we can have models way more sophisticated and effective than we have today. It's just that we haven't been putting the investment into it. And as this idea picks up, more and more people will put more investment into it, and we'll be able to make better models. We'll be able to make models that improve Federal Reserve decisions, for instance, and improve government decisions, for instance. And it also, I think, has a lot of applicability to trading. So what happens when you get a robot that is not just utilized, because I think that most of these high frequency robots, they're utilizing order flow and correlated assets and reinforcement learning to some extent, right? Well, what happens if you're able to combine that with something that understands all of the news and things that are coming out, and something that is able to look at all of these things as flows and model those flows as this constant dynamically updating thing, and kind of like weather, where you have a snapshot, you have your prediction, and then goes along and you have your other snapshot, right? And you adjust based on the errors on it. Yeah, you're gonna get some market makers that maybe fill in some of those holes where we have problems right now. The robot doesn't really know what's going on, and so they just turn it off, right? Do you really think that the new people coming in are going to learn something? Yeah, I do. I think that we're having a real revolution in our understanding of economics, and that 10 years from now, or let's go further out, that 50 years from now, that people are going to be talking about guys like Dwayne Farmer and Jean-Philippe Bouchot in the same way that we talk about like Keynesian revolution and Milton Friedman. I really 100% believe that. There's zero doubt in my mind that is going to happen. And it will take time, but what you're starting to see is the effectiveness of these methods is just so groundbreaking that they can't ignore it anymore. The business side has already kind of been doing this stuff for a long time, and the academic world is just catching up. So yes, when these boomers retire, the new people, they're going to be more and more willing to look at those things, and it really is going to change. And so by 50 years, I think that the teachings of this stuff will be pretty common. Like the idea that the market is perfectly efficient, that's gone. They're not going to teach that people anymore. Are you streaming tomorrow? Yes. I don't know if I'm streaming the Federal Reserve meeting. I haven't checked if my wife is working then or not. I could go and look at the calendar and see. With that, I should probably think about what I want to do here. So I kind of hinted on this earlier. Did I just straight up talk about it? But one of the things on my mind was Octavius really wants the indicators in CR charts, and I was thinking, well, we don't have to do all of the indicators in CR charts. We can just do the inventory cost basis and put that one out, and put it up for like $100 or something like that. And that's a much more manageable project. And although I don't have as much time as I would like right now, because about half the time I am watching kids, but I do usually get at least 2 days in the week that I can work on these sorts of things. And since I already kind of have the code, and I think that it's code that should translate over into C++ fairly gracefully. So I think I could do it and just do that one thing. But there's a couple of roadblocks, right? First roadblock is I do not have CR charts. So I think I have to talk to my broker and maybe, you know, send some other feelers out to see if I can get access to CR charts without having to pay a ton. Because I'm really trying to keep the costs of the stream down right now. The other issue is that with NinjaTrader, I rely on NinjaTrader's licensing system to deal with the licensing aspect of it. I don't know how you do that in Sierra Charts. I don't think that Sierra Charts has anything comparable to that. So I would have to like integrate a licensing system into it, which is a little bit of a roadblock. So beyond that, should totally work, right? What was it? Let me pull out here. Yeah. Can we not start a machine learning project? Well, that does kind of seem like that is another thing on deck, I guess. Let's see here. How do I get it? Where does it go? Yeah, this all totally worked. I lost the link. Hold on. Oh, here it is. Here it is. Okay, I made an affiliate program for the NinjaTrader indicators. So if you go and sign up at that link, and then it will give you a link, and when you use that to forward people to my indicators and they end up buying it from that, you get a 50% commission. Okay, so the more of those that we sell, the easier it is for us to do things, right? And because all you need is like a few, right? A few of those, and that's able to pay for like more data and other things that we would need to be able to expand our offerings. Okay, so if you want to get them on Sierra Charts, get people to sign up at the affiliate link and can, find your friends that are getting into NinjaTrader and convince them to buy the indicators with your link. If I can get to like three this month, or well, February. If we had 3 in February, then that would be enough to probably do some of those things. So those are kind of the roadblocks on those. I have some time today. I am going to send some emails out on things because I think that on the, like, should we make our own platform thing, I think that I've checked off most of the boxes that I need on that one, so I can maybe start actually like trying to connect to a service. But I think I'm probably going to spend most of the day sending out resumes, making a video about the inventory cost basis specifically put on the channel, and then just doing some like elite code questions. That's what I think I'm going to do today, and send out some emails to people to see what we can get. See if maybe some of these other business contacts that I have some ideas to help. I wonder, Zero Charts custom indicator licensing. Well, ChatGPT seems to, the AI overview seems to think that it's a thing there. Oh, we provide a feature where you will have a web-based control panel to specify those users who are allowed to use your StudyUser systems. Specify expiration date as well to have access request this feature and provide us the text you use and the name. Okay, so I have to get access to CR, so that fixes one of those problems. So all I've got to do is get access to CR charts, and then I should be able to write it. Might take me a few days, but it's been a while since I've done C++ code. But doing all this stuff in Rust should make my C++ code better, because I should understand the situations where there's the potential memory leakage and so forth. Do you know some guys that can provide me CR charts? Oh yeah? Wait, how would they do that? like I've been able to get a demo before, so I and tried programming one before, right? So hopefully I can just do that again. But I think that I would want to be longer term thing. And like the question is like they have that licensing thing. So like, can I do that without actively paying for a Sierra Chart subscription? Because I don't want to pay for that. I don't want to do that right now. And I would have to sell, you know, like that's like $100 a month or something like that. So I would have to make more than one sale a month to even pay for the costs of doing it. You know, you go to see where the issues are. But I'm sure that they can answer those questions for me. Oh, somebody's trying to argue with me on this in here. It is impossible to trade without price. How does an order get placed without price? Although big institutions may not use a price chart, they are in fact tracking price in other ways. And I said, just use a market order or always join the best bid, best ask. It's true that price and other data can track closely, but it's just that price is the result. So there's more value to be found in analyzing the other data series and how price reacts to those than there is in analyzing prices. He says, just put in a market order, and how is that market order tracked? Question, by price. Crazy how that works. It all comes back to price, and the other data you mentioned, it is used for what? To track price movement? No, actually not. But what does he mean by how is that market order tracked? You, the person submitting, don't need to know anything about price to submit it. Like, the current price doesn't even have to be on your computer at all. You just say, I'm going to market buy or I'm going to market sell here. That's it. You don't have to have price to trade. You really don't. There are trades that can work without knowing what the current price is. It's just that simple. I don't understand why that would even question that part. The idea is to get it at one price, and so yeah, but you could have a strategy that says, I saw a piece of news that came through. I am going to market buy right now and hold it for 5 minutes. So in order to do that strategy, I don't have to know anything about price. Yeah, when I submit my orders, that order will get a certain price, and the difference in those prices will determine how much money I make, right? But I don't need to know those prices to execute. I execute, and then after the fact, then I look at what the net profit on the on the trade was. But the prices have absolutely nothing to do with me submitting the orders. I can submit an order without knowing the price. I don't know. All I'm going to argue with this person as much as I can, because it will increase engagement. It'll increase engagement, right? Retail bros aren't price agnostic, but you could be. I mean, why not? I know that most retail traders are not price agnostic, but they can be. They could be. You could be. I mean, that's my whole point, is you could be price agnostic. And the whole issue is that what I'm telling you is that you might actually be better off being price agnostic. Look at the order flow, whether the orders are net buy or net sell. Look at the sentiment. Look at the breaking news. All of these other sorts of things that are predictive about what the flows are going to be that day. And then you just take your trade. And you don't care what the price is at that time. You just take your trade and then take it off when your session is done. And those things are going to be more predictive than trying to study the past price history. The whole issue is really the point of that I'm trying to make really is that there's not a lot of informational value in price itself. Retail traders are trying to day trade by only looking at the 1 minute chart of a single asset. And I'm saying that's a terrible way to trade. So much so that you'd be better off not knowing what the price is and just trading off of other things than you would trying to find a pattern in a 1 minute chart. Of course, it's better if you know the current price and all of that information, right? What would be beating you? This is the thing that I think. So this is actually kind of an interesting thing. It's like in the past, it might be like if I'm in the town square and there's some guy and he wants to argue with me, and I argue in front of everybody, and then everybody in the town square is like, oh, well, that's kind of argumentative. I maybe don't want to hang around him anymore, right? So maybe that was a problem in the past, right? But on the internet, there is an endless stream of people coming through. So if I argue with somebody, all that does is increase the engagement on that thread and causes more people to come in and watch the video. Right? Net benefit to me. Oh, that reminds me, by the way, that we're going to change the thumbnail on this a little bit. That video did pretty good, by the way. 250. Like, I think that's almost more than... Also, how to develop trader intuition. Got 380 views total. We've already got 250 in one day. Like, that's pretty good. But we're going to change the thumbnail to make this a little bit easier to see. Now, another side of it is that somebody might come in and like say dumb things, and that can be like a good teaching opportunity. But at the same time, I kind of have to let go of this idea that like I'm gonna save everyone, that I'm gonna talk them out of it. You know, it seems to me that that's just not possible. And then the most of these people aren't going to be convinced and that they're going to continue to do dumb things and lose money in the markets. And it's probably better to focus more on making money myself rather than trying to prevent other people from losing money. Because at the end of the day, it does seem to me that you need a certain amount of people to lose. Maybe people don't like the background music, or really, you think it's the background music, huh? If you look at the average retail bro strat, he's leveraged. Okay, so you're saying that the average retail trader has to keep their loss below a certain amount, and so they have to put a stop in at a certain number of ticks. So even in that case, you don't necessarily have to know the current price though, BS, right? Like in NinjaTrader, I can tell NinjaTrader, give me a stop of 6 ticks, right? So the system will track what my entry price was and how many ticks away, and the stop does all of its stuff. But that still doesn't require any knowledge of price on my part to execute the order. See what I mean? Like the thing is that it all comes down to on my screen, I'm going to push a button, right? And it's going to do something. Ticks are an abstraction of price, perhaps. But if I come into Jigsaw here, right? All I have to do to enter into a trade is click market buy or market sell. There's also this button right here, which is join the ask or join the bid. Okay, but or wait, is that I forget. I think that is just buy at the ask with a market order, but limit order at the bid, something that should execute right away. I think that's what that one is about. I thought that there was one to just say I want to join the bid, but then that should be bid and it should be a buy button. Anyways, I digress. All I have to do to enter into a position is press market buy or market sell, right? I don't have to know anything about the price to click that button. I don't have to know anything about the price to manage my risk appropriately. I just come to this thing and set one of these strategies, and it will automatically set the stop for me based on the price that it gets filled. But Seth doesn't need to know anything about that. That all does its thing on its own. So the whole question is, how is price being factored into the decision that you make to whether to buy or to sell? And I'm saying you can trade without that piece of information. And in fact, I think that the way that most people are trading, they'd probably be better off not knowing what the price is. Why are we stuck up on that particular thing? I don't know. I guess part of me, because when I was doing this, my video editor, before he had edited the video, was like doing the thumbnails and everything, and he kept wanting to say, Can you trade without charts, or can you trade without price action? No, just say without price, because this is a matter of the data, right? It's a question of, all trading is taking in data, analyzing that data, and placing orders based on that analysis. So the key detail here is, what are your inputs? And I'm saying that price doesn't have to be one of those inputs. So your price is just an advertising tool? That's an interesting thought. See, from my perspective, I'm buying because I think that there is some big player out there that is going to have to buy or sell a large amount of that asset that day. That guy doesn't care what price is. I don't care what the price is. I only care that I've gotten in before him because I'm front running him, right? So the current price doesn't matter. In that situation, you will see me get in at the top of a range. You will see me get in at the bottom of a range. You will see me get in anywhere, because all I want to do is get in as early as possible because I think this guy is coming. And I don't care where it is at that time. I don't say, I mean, sometimes I do this analysis where it's like, oh, we're at the top of the range and I think that we have some time and I would like to see if it comes back to the bottom of the range, right? Like I can't do that. But I'm honestly not sure if that really helps me. It seems to me like that the trades that work out really come down to, I knew that there was going to be a big flow that was going to come through, and I was just in before the flow came. And that's all there was to it. So, and like I said, I haven't been able to find, so I've done these things where it's like, okay, if I get some sort of a signal, like, or actually, so one of those tests that I did was, I'm going to randomly pick a time. But I'm not going to enter in exactly at that time. So I randomly pick a certain time and direction every day to trade, right? But instead of taking it exactly at that spot, I'm going to wait for it to pull back a certain number of ticks first. And then does that change my results? And it really didn't. Actually, it kind of changed the results in a way that was not good. Because what ended up happening was, the larger of a pullback that I waited for before I would let it get into a trade, that just meant there was more volatility, and so it just meant that when I did lose, they were bigger losses. So it actually hurt the performance of the system. Right? Like, what is this in, the real issue is some empirical evidence that tells me that I can use that price to my advantage. So on a 1 minute chart, I really don't believe that it matters. I think that on a 1 minute chart, what you're looking at is noise, and all of these things about price action, I really think it's all nonsense. I've never seen, nobody has ever been able to provide a single piece of empirical evidence showing that stuff actually works. And we have a plethora of empirical evidence that doesn't directly refute that idea, but does kind of suggest that what you're looking at is noise and that it's just not going to help you. So why do retail traders spend all of their time analyzing the price? Makes no sense. Really, in the one thing that keeps popping up in the back testing for these sorts of things is that what really matters at the time is the volatility. Know what the volatility is, and that because volatility tends to cluster. If you take a trade when it's already volatile, then your MAE, MFE is going to be larger overall. But that's it. That doesn't suggest that you should go long or short. That just suggests that you should like sell options probably, right? Yeah. It's kind of interesting. Some of those videos didn't get a ton of reach, but like this is tracking okay. And like the overall analytics on my channel seem to be doing pretty okay as well. Let's see here. Well, it does kind of look like that a lot of what happened was I had some good videos at the beginning of 2024 and then didn't release a lot of videos throughout. And so, you know, the views over time just kind of slowly degrades. But I only want to see the one. Yeah, there we go. Let's go by lifetime, actually. So like we did really good in 2023 and then it's kind of come down, but we're starting to get like some spikes and stuff like that. So I would expect it to come back up to here. But we got to get back to like a monthly amount of views of 25K. That's where we want to get to. But I do think that the thing that was really driving the most... No, probably not that one. This one is interesting because I released this video. It didn't do that well at first, and then overall it started to pick up. But I linked that in a lot of other videos and sent a lot of people to that, so... And this Ninja Trader one seems like that was what was driving most of the impressions during that period. Yeah. Make more videos about Ninja Trader, I guess. I don't know. So I'm sitting here going like, well, you know, like no price that I think that that's something that's really useful for people, but maybe people don't, maybe it doesn't result in a lot of views over time. I kind of sit there and think, well, like that should be a shocking thing. Like that should be like, should pique people's curiosity. I don't know if it actually does or not. But it does, I do overall see this thing where really I should be spending a lot more time making videos about platforms and things like that, right? Because that seems to be the thing that attracts the most views. Make a bunch of videos about Ninja Trader itself. Oh, look here. If you do promote or list CRChart on your website or are developing something for CRCharts for use amongst the public or your group, we can provide you complimentary access. Describe what you're doing in the area of development, marketing, promotion, starting an account support ticket. We should be able to provide you complimentary CRChart usage time. The free usage time is given 2 to 3 months increments at a time. Oh, very lovely. How about NinjaTrader Desktop versus the web-based version? Oh, that's actually a good possible video. I don't think I could do that one though, because I'm not using NinjaTrader Brokerage. So to use the web-based version, I would need to be using NinjaTrader Brokerage. This is kind of like part of my conundrum here, is that like I think that some of the best performing videos that I can make are related to NinjaTrader, but at the same time, I kind of am a little bit mixed about how I use NinjaTrader, because I think it's the best platform, but I really don't like that I basically have to use NinjaTrader Brokerage now to use that platform, you know? And I've kind of been fighting that pressure. And I'm getting to the point where I think that they maybe finally drag me out. Shall we start a momentum trade on the NVIDIA short? That's a good question, Rod, because I do think that people are probably getting momentum short signals on that. But I haven't looked at it today yet. I'm guessing that they're probably continuing to recover though, yeah? Okay, so far it is still an inside day. Oh, they actually went lower at one point. Okay, well, so just as a general principle, the way that a lot of momentum strategies work is if you've made a new 30-day high or low or something like that, right? So this is actually, if we go back December, November, October. So this is actually like a new 50-day low, right? So that in and of itself probably triggers some people short. Okay. I'm not going to say that like that's a good trade and everything else like that, because the application of momentum to an individual stock is misapplying it. Okay. The momentum strategy is about applying this over a large asset of stocks. And there's kind of this assumption that this isn't always going to work out. And in fact, most of the time it probably doesn't. It's just that like when it does, it goes down and down and down and down for weeks and weeks and weeks, and you get a huge winner on it, right? But just trying to look at an individual asset and doing that kind of technical analysis to decide whether I'm going to go long or short on that one asset and not management of a whole portfolio is a misapplication of it. Okay. But what we can do is we can kind of look at the reasons why and everything else and place a bet. I certainly think that I would rather be short than long NVIDIA, at least right now. And I don't know how long it will take for them to recover. You know, like one of the things that I've been wondering is like, okay, was it a one-day thing? And let's give it till the end of the day, but it kind of looks like it's not just a one-day thing. So Like larger picture, I don't know if the trade is really NVIDIA, but I think that this is going to have wide-ranging impacts on the markets that are going to affect us for the next quarter or so. Probably. As one of the things that I was trying to say earlier, when we were talking about this earlier, you know, some of the arguments that I've heard for and against NVIDIA, like is NVIDIA actually going to sell less chips? I don't actually know that. I just kind of know what the short-term impact on the markets is going to be and everything, right? But one of the things that I'm watching is like, which side is the side that's coping, right? And basically what I saw a lot of yesterday was a lot of people saying, well, this is the reason why you should buy NVIDIA today and buy the dip. And I was hearing a lot of things that were inaccurate on that side. The reasons for getting in that they did not completely understand what was going on. And or ideas for getting in that were kind of based more on this idea that the market is informationally efficient when it's not. So it kind of seems to me like the longs are the ones that are doing the most cope right now, you know? And that I think kind of says something. Are you using a VWAP drawing tool on Ninja? So I don't use VWAP anymore, to be honest with you. I used to use it really heavily. I had my own version of VWAP that I used. I recently made a VWAP because from everything that I've seen, what you actually want to do is like look at deviation from the VWAP as a percentage of the daily average true range. So I have an indicator that shows you that gives you bands based on that. But I wrote my own VWAP. I think that NinjaTrader has a built-in VWAP, but you have to have the order flow tools to use it, right? It's not super hard to make a VWAP though. I think that if you go on the NinjaTrader ecosystem, you find a bunch of different VWAPs on the app share. Just search NinjaTrader user app share and then search VWAP there. So it is time for me to get going. Is there anything I should review here on the markets? It looks to me like that in the treasury markets, it still looks pretty lackadaisical, but we have made a small move lower, and that small move lower seems to coincide with this pretty strong uptrend that we've gotten in the S&P 500 since the open. So this line right here is the open, and this is the top of the hour. So, or actually 5 minutes before when I usually stop trading. So it seems like it's, you know, treasuries are following the correlations, but overall I still see a market that it looks like they're waiting for the Fed meeting tomorrow. So don't make any huge moves. Don't bet your life on today. It'll be choppy and difficult. But tomorrow could be a very interesting day indeed. So see you then. And yeah, I think that's it. I'll see you guys tomorrow. Stay excellent, team.